Good morning, friends and Facebook followers. Welcome to the next edition of my Saturday morning real estate marketing, market timing video. Looking forward to providing some information of value to you. This is Saturday, the 15th of April, and the real estate season is alive and well. The market is alive, and there is inventory, albeit a little slower than we would hope. There is inventory emerging into the market. If you're looking to be a participant in the St. Louis real estate market and general surrounding area this year, then this is the time to sit up, take notice, and start asking questions and learning what information is out there to assist you in your goal, your quest to purchasing a home, or getting the information to assist you in listing a home and getting the highest return that the market will allow on your real estate. So this is video number 5 of 2023, and thank you for joining us, and feel free to pass information along about this to your friends and family who might be in the real estate market as well. I am Richard Essman. I am the broker and president of St. Louis Realty Services. I am doing a series of video in my Facebook, or should I say YouTube library. I've got multiple years of videos on topics, some of which we're redoing for this particular segment, time in the market. But we have a lot of value out there that might assist you, educate you in the process of being prepared to be an investor in the real estate market, a homeowner. Again, the inventory is going up. In the past week, we have had 1,028 listings come on the market in the St. Louis metropolitan area, and these are all residential homes, not other types of property. We have had 170 coming soon, so there is emerging inventory coming out. We have 116 that were back on market, went under contract, fell through, came back, and we have almost 400 that had price changes. So of this volume that's out there, there's a number of price changes taking place as people are starting to see that the market has calmed from the very active and hyped status that it was at last year prior to the interest rates going up in the marketplace. And we'll talk more about that and bring on a special guest to help us understand more in a minute or two down the road in this video. We had 303 listings go under contract, what we call AC type contracts, already under contract. But we also had 766 go from under contract to pending. So they're emerging through the process of contingencies. Basically, we had about 33% comparison listings going under contract this week versus inventory coming on the market. Generally, I would say that the market is filling up with inventory, which is what you would expect at this time with the nice weather, people getting their houses ready, people getting the interiors completed. It might have been a slow process due to lack of contractors to help out, but with the flowers and green grass and trees and blossom, the exteriors are getting done, mulch is getting put down, and so there's a lot of homes coming on the market right now. So if you're a shopper, if you're a buyer, this is a great time to engage me in a conversation so that I can set you up on a unique property search. You can't hit the bullseye unless you define the target. So I'd like to engage you in a discussion of what you would like to find, and then see what is out there that works for you for price, location, style, etc. The big 3 criteria. There were 802 homes that closed. So we're getting more inventory than we are getting closings. So there's a progression. This will continue until we get a couple months or a month or so down the road, and we're going to end up seeing, as buyers become satisfied as they purchase, we're going to see an inversion of the market, but more on that later on. Right now, it's a great time to be in the market. There is my landing page, richardsmanbroker.com. If you were willing and need information to just supply name and email, there's PDFs and there's notification. You can ask question and I'll be happy to get back to you with an answer. Please use this. This is a great way for us to have a dialogue without having to get on the phone and take a lot of time. I'd be happy to initiate a conversation through that information. So richardessmanbroker.com, phone number, all of that's right there. And there is a link to my YouTube business card video that's 1:09 long that you might want to take a look at. It was fun to make. You might enjoy it. So we're seeing a lot of things happening in the market right now, and people are out there. Don't be hesitant. Don't be a bird on the fence waiting to say, oh, the prices are so high, the market's going crazy, interest rates are high. I want to bring on a guest, Mark Mayfield at preferredrate.com, who is a financial planner and who can address why counterintuitively, if interest rates are higher, it may work in your favor if you are actually a buyer in the short term, maybe even the long term, depending on what end interest rate wise, cost wise, or opportunity wise that you want to focus on. So without further ado, my special guest this week on my bring in the expert segment is Mark Mayfield from preferredrate.com, should I say. Welcome.
Thank you, Richard. Great information. I think anybody that's looking right now definitely needs that information. So my background is I have a degree in finance, specializing in personal financial planning, with my graduate courses completed from my CFP to be a certified financial planner. That is the highest designation in financial planning. It's kind of like anybody can call themselves an accountant, but to be a CPA, you must get your master's in accounting and then pass rigorous tests proving that you know what you know. It's the exact same thing between a financial planner and between a CFP. So I have a really good understanding of what's going on with the macroeconomics and how that boils down to the individual persons and their families' short and long-term financial goals. So a couple of slides I just want to share with you on what's going on with interest rates and how that's going to affect everything. So the first thing that everybody should know is that interest rates, what determines interest rates, right? The main thing that drives mortgage interest rates is inflation. It really, when my college textbooks, the way they explain it is the future expectation of inflation dictates what long-term rates are. Mortgage rates are long-term rates, not the Fed. A lot of people hear the Fed's raising rates and think that mortgage rates are going up. That actually doesn't impact mortgage rates. There are actually times when the Fed raises and mortgage rates go down. Both Fed funds, the rate that Fed controls, and mortgage rates respond to inflation. So there's correlation there many times, but it's not causation. What really impacts mortgage rates is inflation. And here in this graph, you can see the pink line is core consumer price index. So what that is how much is inflation going up? Stripping out food and energy, because everybody views food and energy as their own category. But everything else, how much is everything else going up? And you can see they're very corollary. The only time that they're not is when the Fed was in there actually purchasing treasuries and mortgage-backed securities to artificially keep rates low post-COVID. But as soon as that stopped, again, we went right into it. So the big thing is, where is inflation going? So the number that everybody looks at is when the investors look at is, what is your core consumer price index year over year? And to get that, it's actually not that hard. All you have to do is take the last 12 months. So rates actually spiked. The highest that they got to was mid-October, early November. Why did they spike then? Well, October 12th of 2022, September 2022's reading came out for core CPI. It was 0.6 that month. It replaced from 2021 a 0.3. So this rate went from 6.3 to 6.6, right? Anybody that was listening at the time, I was like, wait till November 10th. Why November 10th? Because October's number was coming out that date, right? And October was 0.6 from a year before, and it was expected to be a 0.3, and that's exactly what we got. So this went back from 6.6 to 6.3. So we actually saw rates go down from the high sevens to the low sevens, high sixes in 2 days. That's very common, right? When we see these big moves in core consumer price index. So the big thing that we want to consider is, what numbers are we replacing, right? October's here now. This is just updated through this week's release of March's 2023's core consumer price data. But the big numbers to come out, March didn't help us really that much. The one number that came out in this month, that came out Wednesday. Why? Because it was zero point 0.3 we were replacing, and we replaced it with a 0.4. So this actually went from 5.5 to 5.6. But if you look at what's coming up, May 10th, circle that date if you're looking at locking in a loan. That'll be a really good date. We should see rates go down into the fives that day, mid fives. By June, when June's number comes out, which is July 12th, this is the big number that Fannie Mae is focusing on. So Fannie Mae is the largest bond issuer in the world. They get the best people from Harvard and MIT going there after college, and they're predicting rates to be at 4.5% later by the end of the summer. Why does that matter? Right here, and this is why they're predicting that. Of the core consumer price index, 43% of it is made up by what shelter is. Shelter and shelter, so rent and rent equivalents, make up of this number. So it's really important to pay attention to this, what number we're replacing here. And we're finally hitting the crest on this. We hit the all-time highs in October, December, and February. Those are highs that we've had since the early 80s. So these numbers, we want to pay attention to this. The big thing about shelter is it lags. So the way that the Bureau of Labor Statistics calculates this number is they factor in over a year. When you sign a lease, it's typically for a year, right? So they average it out versus what people are paying, what real-time rents are. If we look at real-time rents, right, that's this pink line, what people are paying real time, and then the number that the CPI actually uses. So you could see there's a big divergence between the two right now. By them using that lagging number, it does take out the extremes, but it makes it lag a lot. So right now, in March's report that just came out Wednesday, the shelter component annualizes 8.2%. And again, this is 43% of that number, right? Real-time apartment rents, though, are only going up 2.6% a year. So if you subtract the difference there, you get 5.6%. It makes up 43% of core, again, which core CPI, which is the biggest thing that influences mortgage rates. So you take that and you get a difference of 2.4%. So if we were using real-time shelter costs, and I'm hearing this every day on CNBC. They're finally getting around to this. I've been talking about this for a few months, but in the last 2 weeks, I'm starting to hear people say this. Jeremy Siegel out of Wharton Business School is one of the big professors out of there. He's talking about that now. But if we just use that, core CPI would be 3.2% versus 5.6%. It'd be more than 2% less. That's why Fannie Mae came out with this report saying that they see rates at 4.5%. What does this mean to you guys that are looking at potentially buying a home? Well, right now, as Richard just said, inventory is starting to come up, which is great. But Black Knight, CoreLogic, they're huge. They have a ton of real estate data. They said for every 1% that mortgage rates dip, 5 million more Americans can now qualify for the home that they want to buy. So, or just think about it this way. Right now, Richard, if a house is priced well and it's updated, and it's in good condition, that opening weekend, it's going to get 2 or 3 offers on it. Right now, with rates in the sixes, right, low sixes as of Friday. But a year ago, when rates were at 4.5%, that same house would have 40 offers on it. There's just going to be an absolute ton of demand hitting the market here. And what that means when you look at supply and demand, where those two curves meet, the equal prices will be going up dramatically. Because, when do you think you're going to get a better deal, on a house, when you're competing against 2 or 3 people, or you're competing against 40? And that's the key. So yes, you can buy now, and there's a way to actually temporarily sidestep these higher rates with a 2-1 buy down that still gives you a fixed rate, but a lower rate for the first 2 years. And then just do a no closing cost refinance. We have that set up for everybody. We have an automatic search. We're always making sure you're paying the least amount possible versus what's out there in the market. But buy now, where competition is a lot less, save tens of thousands of dollars on that home. And then we'll do a no closing cost refinance for you and get you that lower rate. That way you get the best of both worlds. And you don't have to fight with 40 other people to get your home. So that's what my thoughts are, Richard.
Well,
Anything you make
that's
that?
really good information. I thank
Yeah.
you. And once my eyes kind of stop glazing over with all of that heavy important data, what I see is that for the audience that's listening, who just got an education on the finer points of how the market may work and where the information comes from, and is that we have the rates that are in the 6 to 7% range right now, which is higher than what most people want. But we
Absolutely.
also have increasing inventory. That means there's more to shop on. So that's good, a good thing to happen. And it's typical of the real estate market in St. Louis at this time of year. When the markets start to fall in 30, 60 days or so, they're not just going to go boom. They're going to begin and to make adjustments that way. So if you're going to be a home buyer, this is the time to shop for the inventory. This is the time to not have as much competition out there in the market, depending upon the kind of house you're looking for, the area, etc. All those things are important market segments. But this is a good time to be in the market because there's inventory and the rates will be going down, and you've got a no cost refinance, you've got the 2-1 buy down, you have tools. So if a client is willing to stop and say, how do those tools work for me and what would I expect? You can give them the answers on it and help to have some confidence in the process that I can get through this and it's really not going to be as expensive for me as I thought it might be otherwise. And that's what we're trying to drive home, folks, is there's ways around the fear that might cause you to think the market is too high, too expensive, too much going on out there with multiple offers. It's not quite that way right now. The boots on the ground are telling us different, and the statistics are backing it up. So my statistics that I mentioned earlier on climbing inventory melded together, dovetailed together with what Mark was saying, is that this is actually a good time to be in the real estate market if you are going to be a buyer. Okay. Not later, but now. Now, if you have a home to sell, it makes it a little bit more difficult. You might want to think about how the market will react to your home now versus what it'll mean to have a few more buyers. If you're downsizing, you may end up with an advantage of buying now. You may end up with an advantage of waiting if you're going to be getting more out of your house than it's going to cost you to purchase. So these are the type of things that we can examine. So if I know what you're looking for, the type of home you're looking to buy, or the type of home that you have to sell, I can look at your market and tell you whether or not you're better off jumping in now or better off waiting a month or two to see what happens. If you need to get your home sold in order to claim the ability to borrow back, then we got to work the two hand in hand. They got to be coordinated. And that I've got 30 to 40 years of experience helping to coordinate the sellers and buyers in a transaction when you have to be one of each. Okay. So I quarterback the deal for you, make sure everything is seamless and work it all out. And I've got great experts on the loan end. I've got title companies and building inspection companies and all of that. I am going to be putting some of these people on my next videos. We have a variety of topics coming up in the coming weeks, including the vacation rental market in Florida, particularly the Naples, Fort Myers area. So we have different guests from different areas. We want to keep it interesting, change it up, but we'll always start with the market statistics and what those mean for you in the here and now time. Okay. So if there's any questions, you are welcome to call me. You can go on my landing page. You may reach out in any way you want, and I'd be happy to assist you. I want to make sure that you've got the knowledge and you have answers instead of just questions. So I want to thank you very much for your time and attention on this. I want to thank a number of clients, the past, the Lads, the Ladermans, the Montelanos, the Davises, and many others who were clients that closed in the month of April over the past years. Thank you all for that. Again, a big shout out and thank you to Coach Manny. Manny is my marketing and video coach presenting the Zoom for us. He was on a previous YouTube video a couple of weeks ago. Coach Manny, thank you very much for putting this together and all the great slides and everything. A thank you to Mark Mayfield with preferredrate.com. Thank you all, one and all. Reach out to us. Let us know how we can, provide value to you today. Thank you for your time.